All right. How you doing, folks? Happy Friday, September 26th, 2026. Today is our weekly roundup. Joining me is our co-host, Randy. Randy, how you doing?
Doing good, Hamilton. Doing good.
Great. Really liked what we did last week, and I kind of just want to go through the same, at least have the same vibe as we did last week, where we're just bouncing ideas back and forth. We're going to go through a couple trades that we potentially want to be putting on as early as next week, but let's focus on bigger picture stuff here. Obviously, this week, I'm going to go ahead and pull up the data on CoinFin. This week has had a pullback, right? I mean, for a majority of high volatility assets, the market has pulled back. You can see the weekly return here in CoinFin. A majority of the assets that we track are down on the week. Let's just address the elephant in the room. Randy, should we be worried over the next couple of weeks that the market could potentially correct?
Correct. Correct's a strong word. I could see this being a deeper pullback, but this doesn't change anything as far as our long-term bias or even our intermediate-term bias. So,
So what do you mean by that really quick? I want to point that out because people use that term all the time. You see on X, if anybody posts anything bearish whatsoever, you got the reply guys out that are like, a correction is coming. What is a correction by definition, and why do you not expect that to occur?
correction is something, I believe if you measure it from the highs, it's a 10% move from its highs. So it's a very steep sort of, I can't even say pullback. I don't know if that would be categorized as a pullback. Maybe it would. But, I just don't think we would see that because a lot of the risk on measures that we look at certainly don't indicate anything like that. If anything, maybe we did go up too high too fast, but I mean, we're not like overly the sentiment is not frothy enough to where I could see something like a 10% correction. I mean, yesterday we had a gap down. It was less than a 1% move in the S&P 500, and stock market crash was trending on Twitter, which I could not believe.
I mean, it just goes to show you that people have one foot out the door already. And so any sort of adversity whatsoever, they're out. And that's fine. That's good for us. We understand taking the weight of the evidence approach, what to look for in terms of defining, is this a pullback that we should be buying or a potential correction that we should be looking to get out of the way of? And I mirror your sentiment. I don't think this is going to be a correction, which to validate your claim there, a correction is 10% or greater. Get up into the 20% move, and you're talking into changing from bull to bear to bull. So correction is anywhere really between 10 and 20% by textbook definition. We generally get one of those per year. And for those of you that are keeping track at home, we already had one of those. Yeah, we had one from February through April. As a matter of fact, we had damn near a 20% move. So would it be out of the realm of ordinary to see another correction this year? Yes. That's not to say it can happen. But probability-wise, it's probably not going to happen. We average one per year, and we already got it. So I want to kind of shift gears here because you brought up a great point. Trend matters to us. Inside of TTI, we look at three things. In particular, we look at trend, relative strength, and momentum. When we're trying to define whether or not we want to be long, short, or potentially cash, we always look at trend first, and we define our trend in three different ways: short-term, intermediate term, and long-term. Now, you don't have to do it the exact same way as us, but generally what we like to do is we like to look at the 200-day moving average, which is this black line. You can throw a 50-day moving average, which is your intermediate term, and then you can throw something like a 10 or a 21 as your short term. And if you get confluence across all three of those, you have to be trading in the direction of that trend if you want to make money consistently. It's very hard to trade against the trend. And what we've seen so far this week, and don't let me just tell you, let's look at it, is we haven't even broken the 21. We got a pullback to the 21. We're still above a rising 50. We're still above a rising 200. And at least as of right now, we're above a rising 21. Now, we could potentially close below yesterday's lows, and we could crack below the 21. But over the last couple of months, that has been historically a buying opportunity, which really leads me to the point of this. As long as your intermediate and long-term trends are still pointing upwards, you should be looking to buy the dip, right? So once we clearly define the trend, which you could do across any major index or average that you're utilizing to define the direction of the market, we're using the S&P 500 here, but you could use the Qs, right? The Qs are arguably more bullish than the S&P 500. You could use the Russell if you're trading a bunch of small caps, which surprises me. We've held the 21. None of this at least from a trend standpoint right now, is screaming that this is going to be anything more than a pullback that should be bought. My line in the sand for that thought process, and Randy, I'd love to hear your thoughts, is if we break the 50-day moving average, if we break the intermediate term trend, that's when things start to get dicey. That's when you really want to step back, take a second, kind of, make sure that the primary trend is still valid. But if we're still trading above an upward sloping 50-day moving average, you are in bull market territory by far, and you should be looking to take advantage of pullbacks. What do you think? Am I off base there?
Right. No, I agree. To be fair, I don't really look at the 50-day too much, just because I feel like I can just get a clean sense with just reading raw price action. But you said the slope of it, and yeah, the slope of it is really what matters here. If you go back through even, let's see, coming out of post 2000, the 22 bear market, there were just a handful of times where the slope was truly negative for the 50-day. That first time came in the second half of 2023 when we saw that 10% correction. You can see the slope starting to shift sideways and then turn down. And then recently with this latest little panic crash that we saw at the start of the year. So it's the slope that really, yeah, exactly. It's the slope that really matters. So being above, being below, that does give signs, and I think some people do look at that, but really it's the slope of this that matters. Also, just real quick with the 21 day, because I don't even have that up on my chart. I used to, but not anymore. If you look, and whenever we're trading in a strong uptrend, these can actually be very nice contrarian signals. Same thing with the shorter term breadth measures too. Whenever you get something that's trading below the 21 or something that has or an instance where there's very weak breadth in the market, these could be some of the greatest times to get in. Just as a recent example, in August of this year and in September of this year, we saw times where the S&P 500 gapped down and was below the 21-day moving average, and those turned out to be great buying opportunities. Now, that's not to say that this is going to be persistent. In fact, it won't be persistent. At some point, that's going to die off here. But shorter term, you want to be contrarian, but the intermediate term, the long term, those are where the trends exist. Those are where the trends last. And that's, frankly, the easiest and simplest way to look at things when it comes to trending.
Yeah, so I'm right on board with you. The only reason why, for example, we use short-term trends in TTI is to set expectations on whether or not we should be looking to actively be buying dips or if we should just be looking to sit in positions on and make a bunch of money. For example, we gap up, we'll say 3, 4, 5% above the 21. Is it really the time to be buying stocks, or should we just sit back and wait for a mean reversion? Things like that. We're just trying to establish expectations. One thing I do want to point out though is for those of you that are taking the same time frame as us, we like to take trades for weeks or months, not intraday stuff. In the short term, sometimes we get lucky enough, which I'll show you guys in a second, where we can turn trades free by hitting over 100% within a couple of days. But we're very rarely targeting anything less than 45 days out. Realistically, we like to sit somewhere between 90 and 180 days out. So the short-term trend doesn't necessarily dictate what we do from a positioning standpoint. And I think if you're within the same type of time frame as us, if you're swing trading, you have a job, you're in a company, whatever, don't get lost in the short-term volatility. Really don't. There's a lot of people out there that I see on Twitter or X or whatever you want to call it every day. They're swing traders and they're freaking out about short-term moving averages. It would be best just to take them off of your charts if you're not utilizing them as a way to establish expectation. Really quick, you talked about market breadth, and it's important up to a point, right? There's arguments on both sides. Is market breadth important? Is it not? What really pulls the market upwards? I'm in the camp that market breadth does matter. And you brought up a great point that the S&P 500 gapped down, but market breadth continued to show strength. And that gave us more confidence to be buying the market sub 21-day moving average. I'm going to go ahead and point out 2 market breadth indexes that we can look at on a consistent basis, and we do look at. They're both just very, very easy to read. First one's RSP, equally weighted S&P 500. And it's the same conversation we had last week, where as long as we're trending above kind of this 188 area, which as of right now, I'm going to say we're consolidating there. We've been consolidating there for the last couple of weeks. As long as we are not definitively breaking down from the 188 area, primary trend is still up, and I expect this to act as a launch pad higher. If we think about market breadth in terms of the equally weighted S&P 500, yes or no answer, is this bullish?
Yes, trading up at all-time
Yeah.
highs. Absolutely.
Yeah, okay. Let's look at QQEW really quick. The equally weighted NASDAQ, which was just at all-time highs 2 days ago. One word answer. Is this bearish?
No.
No, it's not. I mean, so again, if it's easy to go on Twitter and scream about market breadth and cry about it, but when you peel back the layers and you actually look at the data, you don't take people's tweets at face value and you look at this stuff. And there's a million ways to look at this, right? It doesn't just have to be equally weighted ETFs. You could look at EQAL, which is something you brought up earlier this week, which is trading up just like the RSP or equally weighted Russell 1000, up near those all-time highs. You can look at the health of the percentage of S&P 500 stocks trading above key moving averages as of right now, 59%. Let's go ahead and turn this into a line chart. 59% of the S&P 500 is trading above its 200-day moving average, which is not bearish. You have right now 47%, which coincides with this kind of late summer weakness, trading above their 50-day moving average. So again, is this a pullback or is this a potential for a bigger correction? I think right now we're still in the camp that this is a pullback. And you can go and look at these market breadth statistics yourself. You don't have to take our word for it. You don't have to take the crazy guy that's been saying the market's going to crash for the last 6 months word for it. Go look at it yourself. What do you think about market breadth? Is there anything I'm missing here?
No, Hamilton, I think you hit it on the head. I don't think there's anything too concerning from a market breadth standpoint. And if we go back to the equally weighted indices, if you look at the action to going into 2022, I mean, you can see deteriorations in both the Russell 1000 equal weight and the S&P 500 equal weight. And right now, we're just not seeing that. So no, I don't think breadth is concerning at all right now.
Now, I do want to point out that it's not inherently super strong right now, but for the people out there that are screaming market breadth is weak, it's just not true. Market breadth is not weak. You can throw up an advanced decline line. You can look at number of advancers versus decliners. You can look at volume. You can look at whatever you need to utilize and take a sum of the components. Look at 5, 6, 7 of these different market breadth components, and you're going to realize that a majority of them are still very much in the bull camp. But as always, market starts to slip a little bit. People start to give in to the tendency of, okay, that's it, that's the top. It's easy to make that decision, but it's very wrong most of the time. I want to shift gears really quick, and I want to talk really quick about sector strength because that's obviously super important for us. If we go back to the beginning of the month, I want to point out that we already know August is supposed to be one of the weakest months of the year. September is the weakest month of the year, particularly for the NASDAQ. That means your tech components, your comm components, your consumer discretionary components, which represent all of the NASDAQ, 50% is tech, et cetera. We have the tech sector up 5.96% this month. We have comms up 5.78, and consumer discretionary up 2.71, outperforming the S&P. Again, when we think about risk on versus risk off, should these sectors be outperforming everything else in a month that is seasonally weak, assuming that we just topped out?
I mean, you want to see risk on. Look, if we were going into something bigger, we want to see that risk off start to outperform, and that's not what we're seeing at all. In fact, in a seasonally weak period, we're seeing the strongest areas of the market take charge, and that's unusual. But that also caters to, okay, this market really has some strength behind it. You mentioned the 1 month. If we go to a year to date, so this is a broader sense. Top 3 sectors: communications, technology, industrials. The bottom 3 sectors: healthcare, consumer staples, and real estate. So that alone just tells you a picture of what the
Yep.
sentiment is like in the market. You don't have to overcomplicate this at all.
At all. And a lot of people do. As a matter of fact, yesterday we saw the dramatic pullback in crypto, which, hand up, I was caught in as well as everybody else. But we have to make the decision, is that it? Are we throwing in the towel? Is that the end of the move? Or is it just part of the process of trying to capture bigger trends? And as once again, I'm trying to kind of prove this with data and not just my opinion, it's just not right to say that the weight of the evidence is supporting a bearish correction coming anytime soon. We have gold miners leading month to date, also year to date. Gold miners absolutely killing it. But we also have clean energy, semiconductors, software, right? Again, if this followed the seasonally weak pattern that September normally has, we should assume that these industries are probably going to underperforming, particularly clean energy and semis. But they're not. They're in the top 5. So again, it really goes to show you the resilience of the market right now. Even though we're pulling back, there's some chop and volatility. You can chalk it up to seasonality, chalk it up to whatever you want. But to say that this has been bearish price action over the last 3.5 weeks is just simply not true. What do you want to talk about? You want to talk about risk ratios? What's a risk ratio we can look at right now to kind of continue this conversation forward about whether or not we're bullish or bearish? Because as you know, we're going to see positioning change amongst the largest financial institutions before we see an absolute drop in price. We're going to see them sell certain things and start getting into other things before price drastically changes, because obviously if you're a financial institution and you're tech heavy, you can't just market sell your tech. You know, you're gonna lose so much. So you're gonna see this rotation out of specific areas of the market and into specific areas of the market if the market was really starting to move to a risk-off standpoint. What's your favorite risk ratio? Let's talk through it.
My favorite is the RSPD divided by the RSPS. So it's just the equal weighted consumer discretionary versus consumer staples. And also, I forgot to completely send you this chart, Hamilton, but I was doing some work yesterday, and it turns out that is actually the best ratio going forward compared to the growth and value and then high beta and low beta. But, I'll just say this, and I wish I had the
That's
chart pulled up.
proprietary information.
Yeah. But I did a very simple test because we all hear that, these risk ratios have some sort of predictive value, or sometimes they even lead major moves. So I wanted to test that fact. And it turns out that, and I did a very simple study, very simple. All I did was I took the equal weighted consumer discretionary to consumer staples, and then I compared that to the moves in the market. So I used the S&P 500. And I looked at the times where the ratio was above. I just put in a 150-day simple moving average and below a 150-day simple moving average. You can alternate that between 100 or 200. I just used 150 just because I was just throwing stuff out here. And in 1, 2, 3, and 6 months, I didn't test any other time horizon. It was just the 1 month, the 2 month, the 3 month, and the 6 months. If you were above the 150-day moving average on the equal weighted consumer discretionary to staples ratio, that gave you a higher return over compared to the market than if you were below the 150-day moving average. So what that tells you is that, and it's really hard to visualize this without a chart or data, so I'm sorry about that. But what that tells you is that whenever these risk-on sectors take charge and are outperforming the risk-off sectors, then there is predictive value that the S&P 500 will move more because of that fact, because risk on is beating risk off. Now, it's a marginal difference in like 1 month, the spread is like 1% when it's above or below the 150-day moving average. But as you expand, it goes higher and higher and higher. Like 6 months, we're at nearly 3.75% difference. And whenever you're playing with options or any sort of leverage component, that could be meaningful.
Oh yeah.
That could be meaningful. So these definitely do have predictive value. And the fact that we are trading at all-time highs that and recently broken out really tells you something.
Listen, first off, that was fantastic. For those of you that are getting your first dose of Randy, this is why we brought him on. He's the numbers guy, and he's absolutely fantastic at it. But if you break this down like a Dr. Seuss book, it is really as easy as just offense versus defense. Financial institutions are the ones that are moving these types of primary trends. It's not retail. It doesn't matter what I think. It doesn't matter what you think. It doesn't matter what all of us think collectively. It's the financial institutions and the professional money managers that are consistently moving trillions of dollars of assets under management. These are the guys that are moving these primary trends. And when you see equally weighted consumer discretionary outperforming equally weighted consumer staples into all-time highs, even with this week's pullback, we are up on the week, meaning once again, offense beats defense. So if you're in the camp that this market has to pull back, I'm going to go ahead and here's my spiel. If the market is going to pull back, you should see this ratio break down. And we're not seeing it. As a matter of fact, we're trading at all-time highs. So again, we're trying to build this thesis out. Is it time to flip short? Is it time to get in cash? Is it time? I know so many like bozos that have screamed raise cash over the last couple of months and they've been wrong. Are they going to continue to be wrong? I look at something like this and I go, yeah, they're probably going to continue to be wrong. It just doesn't strike fear to me. The other one we like, which you alluded to, was higher beta versus lower volatility, right? We can think about this as well, risk on versus risk off. Think about the types of stocks that are in higher beta. Think about the types of stocks that are in lower volatility. Think about what they represent And we were trading at all-time highs last week. We've got a little bit of a pullback this week, but the trend is very obviously up.
Yeah, I mean, again, go back and look at the 2022 bear market and the action from these risk ratios going into that, and you'll see them completely break down.
Yep.
We're not doing that. We're at
No,
all-time highs.
we're at all-time highs.
So,
There's one more I want to talk to. Then I'm going to flip through a couple charts that you sent over, and then we're going to talk through some trade ideas, and then we're going to call it a session. But you love HYG against IEI. Why don't you talk about this really quick? What does it tell us, and why do you care so much about this?
right, so this rate, let me pull that up on my thing. HYG IEI. Here we go. Yeah, this ratio is basically like a sentiment ratio for the credit markets. So high yield grade debt is the most speculative debt that you can get. It's comparing high yield grade debt to the investment grade debt. So I think, right? IEI?
Yeah. Yep.
And so whenever you get that ratio going higher, what that essentially is telling you is that high yield grade debt is being like more, it's more in demand than the safer debt. And so
The
if you
big
take
boys at the
that and
top would prefer to own the riskiest debt over the riskless debt. And that does not
that's right.
scream bear market. I mean,
That's right.
go
That's
back.
like the same thing to like ARK compared to S&P 500,
Yeah.
except it's in the credit markets. You
And,
know,
the,
people
and you
want the
know,
more
but there's a
speculative.
lot of people that are screaming that, if we're going to see a big problem in the markets, we're going to see it in the credit market. Are we seeing it in the credit market? No, again, we're not. We're not seeing it. It's almost like people are chasing ghosts out there. They're looking for a reason to confirm their bias, and they're going to go find the data to confirm that bias. But when you take a holistic approach and you look at everything and you go, okay, does credit look bad? No. Does market breadth look bad? No. Does momentum look bad? Well, you can pull up MTUM. Does momentum look bad here? No. Or what are the indexes doing? They're up, right? So again, when you're thinking about pullback versus correction, should I be buying or should I be like hiding? Right now we are firmly in the buy the dip mode, right? And we don't want to buy the dip arbitrarily. Obviously, we have rules that gets us in to trades that are pulling back as well. We don't just dollar cost average into these trades because we're trading a lot of options and we don't want to do that. That's bad news. But we are firmly in the camp that this is nothing more than a very usual pullback in the end of September into October. We've all heard the old sell Rosh, buy Yom Kippur. Yom Kippur is next Thursday. Whether you believe it or you don't, it doesn't matter. What matters is end of September generally tends to be weaker than the beginning of September. We're seeing it. What are you going to do about it? Are you going to hide from it? Are you going to cry about it? Are you going to short it? Or are you going to be an adult and buy the dip, make a bunch of money through the end of the year? Right? I think it's pretty straightforward, at least for me. Really quick here, as you pointed out, 5-month win streak. You sent this over. Chart from Mr. Ryan Dietrich with Carson. Do you want to talk through this really quick?
Yeah, I mean, this just helps. I mean, this is just data to back up what we're seeing through the charts too, but it also alludes to the fact that, okay, whenever we have 5 months in a row, what continues or what is likely to happen over the next month, 3, 6 months, and up to a year. And what this table really highlights is that, momentum exists, and, these strong bid months continue to see outperformance in the later months. So.
You're right. It's momentum. That's what it is. And we track momentum every single week inside of TTI. We have the data to support the fact that momentum is real. Momentum tends to carry trends in the direction that they're already trending. I think that's one thing that most people have a problem with. They think that if something is trending, it has to come to an end, which they're right. But the simple fact is, a majority of the time, the trends are going to continue to trend a lot longer than most people expect. So instead of trying to time that, instead of trying to impart your bias on the market and say, we have to sell off here, why don't you just ride the trend higher, right? Like gold's a great example. We bought gold in March of 2024. We've taken profit on that gold trade. We've added back into that gold trade 4 times. We have a trade right now on gold up multiple hundreds of percent, and it's continuing to trend higher. Silver is another good example. Instead of trying to time the top in these trends, as Mr. Ryan Dietrich points out here, just join the trend and ride. Last one before we go into some trades here. Bitcoin versus NASDAQ. I see that you just posted this. What are you trying to convey here?
Oh yeah, well you just said it actually is that whenever you see a strong trend, whenever you have a lot of conviction in it, I mean you don't want to wait for the optimal spot. You just want to get in, and the crypto Monday's open, it was like -5% for Ethereum. I don't know what it was for Bitcoin, but that shook a lot of people out. And then we also saw some ugly price action yesterday. But I mean, here's the thing, guys. Crypto is the farthest risk on asset that you can get. Because it's so far out in that risk curve, whenever you see the market pull back, it's definitely going to be more sensitive to those price fluctuations. So that's why we saw such a big pullback, in my opinion. But look, here's the thing. If you look at the trend of Bitcoin compared to the market, we've been in a very outperformant trend for crypto compared to Nasdaq. Now I didn't do the S&P 500 here, maybe I should have, but what this shows you is that you have these wiggles up and down throughout this trend, but overall this has gone up, and this is the simplest, best way of trend trading, right? Finding spots in the trend. They don't have to be the best spots. They just have to be a spot in the trend, having enough time if you're buying options to let that trend play out. Because here's the thing, guys, whenever you're doing crypto and you see these huge spikes up or down, if you're trying to catch the move for the next day or maybe the next week, good luck. Okay,
I
but
mean,
this
I think
trend
you hit something that I want to touch upon really
4%.
quick. It's that if you're constantly focused on the perfect entry, you're gonna miss 97% of the best trends you could fucking grab. If, for example, I say this all the time inside of TTI, don't miss the dollar moves for the penny entries. Meaning, if you have like a limit order, let's say you want to get filled at 250 on the dot and you're down at 252, buy the fucking position. Don't wait for that last 2 pennies to get filled if you're on the fence and it looks like it's going to reverse, sort of just buy it. You don't need to wait for that 2 penny because if you miss the entry, playing the catch-up trade is the hardest trade in the market. The catch-up
Right.
trade is harder than anything because, as we know, when things start to break out, FOMO comes in. When FOMO comes in, market tends to make the late buyers pay, right? They dump on them. You think you bought the top, you feel like an asshole, you stop out. Then next thing you know, 2 days later, price is above where it was just 2 days prior, and you get back in, you're like, fuck, I can't believe I sold. You get back in 3 days later, you get a nasty pullback, and the next thing, and then it's like you're just in and out, in and out, in and out, just taking these paper cuts over and over and over. And on top of that, you're frustrated. Your guys, your friends, your community members, whatever, they got in 2 weeks ago, and they were able to turn it free, and now they don't care. They're just letting the trend pay, over time, and you're constantly fighting for an entry. That's why I always tell people, don't miss the bigger trade trying to grab the perfect entry. The entry, arguably, is going to be the least important part of the entire process. I want to say it's not important, it is, but it's the least important part of the process. Just get in, you identify a trend, find an area where it makes sense for you to add some exposure, and then ride that trend higher. As you said, Bitcoin and NASDAQ, they oscillate back and forth. We did a lot of work on Bitcoin versus gold, which is, in my mind, the same trade, but they take different times at running. Gold will run, Bitcoin consolidates, then gold consolidates and Bitcoin runs. We'll see if that relationship continues, but it's been that way for the last year and a half. And I'm looking at IBIT right now, and for me personally, this looks like nothing more than a pullback into a resistance turn support.
Right.
Yeah, I mean,
I agree.
this is TA 101. I'm not going to be freaking out about this type of stuff until we get a clear reversal in trend. We had such great entries early on that it would be such a pain in the ass to sell everything and then try to time the perfect bottom. Because let's be honest, most people are not going to be able to do it. We got shit to do. Most people have jobs and companies and kids and other priorities. To sit there and pretend that you're going to be able to time the absolute bottom, I mean, good luck if that's your thing. Okay, let's go really quick. I don't want to take too much more of your time. Give me one chart that you're looking at potentially buying. Let's say the market bottoms today, tomorrow, or Monday's open. We gap up and it's buy mode. What are you looking at here?
Oh man, I'm looking at Ethereum, baby.
All
You
right.
already know. You
Well,
already know. And here's
let's
the whole
pull
theme.
up the actual chart itself. Go ahead.
Here's the whole thesis with crypto, right? I saw man, I forgot to send this over too, now that I think about it, but I saw a chart that showed that a lot of crypto's gains come in the last quarter of the year. And the bias for crypto is up. We can just look at the trends for that over Bitcoin. We can see that the bias is up. Since 2023. So that's a big tailwind. Now, here's another thing too. Ethereum has recently started outperforming Bitcoin. A lot of the guys inside of TTI have done incredibly well and have positioned themselves incredibly well to take advantage of that. So here's the two things going for this trade. First, crypto is still strong despite this last pullback. It's just pulled back into a risk on a very easily defined support level, in my opinion. And then two, if the Ethereum ratio continues to go higher, then that means Ethereum will outperform Bitcoin. So if crypto is setting up to have a nice run at the end of the year, and if Ethereum is going to continue that outperformance, then it's just a simple no-brainer to me. And then this morning, I don't know if you've got that chart that I sent you, Hamilton, but I mean, it looks exactly like Bitcoin. Um, the pullback cannot be more defined on a prior support or resistance level. And I'll be the first to admit, when I started trading, I was like, I saw all these levels. I actually watched TTI for a little bit, and I was like, why does this make sense? Why does this happen? But this happens so much, and the level cannot be more defined. So that is probably my favorite trade
I mean, I'm right there
going
with
into
you.
the
I
year.
mean, I'm there with you, 100%. First off, the Ethereum versus Bitcoin ratio, as we pointed out in May, this thing ran 400% and it took almost 2 years. So as of right now, we're up nearly 100% from the May pivot where Ethereum started to outperform Bitcoin. I want to point out that it's not going to outperform every single day. We had periods where Ethereum underperformed Bitcoin, but over the long term, which once again, if you're a TTI trader or if you're thinking of joining, we care more about the longer term stuff than we do the day to day. You cannot be tricked by the day to day. You're here to make money over the longer term, intermediate to long term trades, weeks or months. Look at the broader trend. The trend is now up in Ethereum against Bitcoin, and I'm 100% on board with you. Now, full transparency, the latest Ethereum ad that I put on did not work. We're using ETHA to get in and get out. That on the books stopped out yesterday. Want to point out though that we've put 5 or 6 positions on in Ethereum. 5 of the 6 have been big winners. So now we're looking at potentially reallocating. Now, personally, I'm going to wait for the right side of the V. So I want to see some sort of bounce in Ethereum and then some sort of level get broken. But a pullback into this level, as Randy pointed out, this is a simple resistance now turned support. He said it doesn't make sense why it occurs, but this is literally TA 101, right? Resistance and support are the building blocks of technical analysis. You flip a resistance level, it tends to turn into support and uptrends, and that's exactly what we're seeing right now. So yeah, on board. I think the weekend price action is going to give us more confirmation if this is going to hold or not. But come Monday, we're up and over, the 39.5 or the 4,000 level. I'm on board. I will reallocate more capital to the Ethereum trade. I think it's a good opportunity here. I'm going to go out into the risk curve. So I know if you're thinking about crypto, that's already inherently more risky, but I'm going to go out to SolarEdge really quick. It's going to take me 2 seconds to talk through this. Let me make the case to own a solar name at minimum 1, or a clean energy, if you will. Clean energy, solar, both outperforming month to date. Clean energy up 15%. Solar outperformed, and clean energy outperformed the first 4 years of the Trump admin. Outperformed everything by a lot. We're starting to see it happen again, which is just so funny because the anti-conservative crowd, if you try to trade that trade, it's not going to work. It didn't work the first 4 years. It's not going to work again. The drill baby drill shit that Trump and the conservatives are saying did not translate to positive price action the first 4 years. It is right now not translating to positive price action as of this administration either. What we're seeing is an incredible outperformance, once again, by clean energy and solar. And so what I'm looking for, a lot of these clean energy and solar names look like dog shit. They look terrible. So I'm looking to scoop up some of the worst looking ones that have potentially flipped their primary trend higher and given me a new level to risk off of. And that's exactly what SolarEdge gives me. It looks ugly here because it's in log chart, but I want to show you just how bad this particular trade was, or this stock, lost nearly 98% of its market cap. Off of its low back in November, right when Trump got elected. It is now up 265%. I think SolarEdge has bottomed. I think a lot of the solar and clean energy names have bottomed. I'm using the 32.5 area as my entry. I've already started a position in SolarEdge. I will add more next week, assuming we continue to hit new 52-week highs. It's just as simple as that. Price targets are 45, 75, and 67, and I expect this to, arguably going to turn into a bigger trend than what it normally is. And I want to get in early. And it's not just SolarEdge. There's a bunch of TAN, a bunch of PBW names that are all running. Pick your poison. But for me personally, I want to get a head start on these because if it does turn into like what it did back in 2017 through 2020, 2021, I don't want to wait. Like I said, the catch-up trade is the hardest trade, and 32.5 is a clear risk on level for me. Look at the bullish momentum. mean, look at this. We haven't even broken the 50 RSI since we broke out. I mean, this is insane. So that's my trade, Solar Edge. I'm buying more next week. Yours is Ethereum. I like that trade as well. Is there any parting words you want to end this with?
Well, just I wouldn't overcomplicate it. I mean, we can see how easily people flip from going completely bullish to completely bearish after a 0.7% gap down yesterday. It takes a lot more than one day or 1 week to change a trend, and the premise of capturing a trend is to not get the absolute bottom or not get the absolute top. It's that meat in the middle that we want. But if you're focused on trying to sidestep every potential pullback, then you're going to miss out on a lot of the benefits that trend trading does. So I wouldn't overcomplicate it. We're seeing everything that we need to see with the market. There are a few cracks, sure, but the weight of the evidence is the upside. So, I mean, that's all I can say.
Let's answer a couple questions and then we'll call it a session. First question. So there could be a moderate or minor pullback still, if at all it happens. Do you make changes to your portfolio now or later? What do you think, Randy?
That's a good question. With pullbacks, I wouldn't do anything. I would just take the heat and not do anything, because if you get a pullback, you're going to want to do something like when you're in the middle of the pullback. And whenever you do that, the pullback could end and we could resume a trend higher. So, that's a great question. I wouldn't do anything with any pullback. If we're getting some sort of correction, then maybe I would do some things. Maybe I'd trim positions. Maybe I'd go in with smaller size. But for just these 2-3% pullbacks, I wouldn't do anything at all.
So I'm there with you. I think the adding smaller size, for those of you that were in TTI going back to April, it's exactly what we did, right? We took smaller size and we took shorter term trades once we started to realize potentially the market had bottomed. Like back half of April, we were putting capital to work. Midway through May, we were like, all right, we're back. This is a bull market again. And we started going out. And by the way, back in middle of May, we were buying January expirations. And all of those are free and majority of them are worth a lot of money right now. So we caught that trend early. The problem I have with trying to make portfolio adjustments for every single pullback is simply this. More people lose more money from a discretionary standpoint trying to hedge a portfolio than simply riding through and allocating more capital once the market has bounced into leading names. I think that's super, super important to highlight. If you are focused entirely on hedging everything perfectly, you're going to do one of two things. You're going to hedge too big, and the market's going to rally in the middle of the pullback, and you're going to lose all the money on the hedge, and you're not going to be properly in the mindset to buy the dip at that point because you're hedged, your inputs, and they're not working. And you're like, what the hell? And secondly, even from the data that I've looked at, we used to look at, inside of TTI, I used to look at all the traders' trading statistics. I mean, like once every month, I would look through people's trader views and stuff and look at this. And I would go and I would look at the shorts on their books. And people are like, well, I kind of want to short this. I want some short exposure here just in case. I'm not saying don't get short exposure in a bull market. If you want to, feel free. But a majority of those trades are not going to work. They're not. By definition, the trends are up. So in terms of portfolio management, if something turns into a bigger move than a pullback, which we'll say, like you said, 3 to 5%, then we will take defensive measures. I'm not looking to perfectly capture every single oscillation down. That's not my thing, because when I do, over 15 years I've noticed this, the people that are focused on capturing every move to the downside and then once again realigning to the upside, one of two things happens. One, they're either lying, they're on Twitter saying they caught everything perfectly, and if you've spent any time in the market at all, it's a lie. But secondly, you end up missing the bigger move, either to the downside or the upside. And I would prefer to grab the bigger move. So again, from a portfolio management standpoint, anything deeper than like a 5% move, you could half R, quarter R into new trades, meaning lower your position size, see if the trend's back, and you can make a couple bucks. And if you do find some consistency, 1, 2, 3 trades where they're working, maybe the trend's back, go deeper in. But I would really just ride through this and manage your risk to the upside. Manage your risk to the upside.
One more thing, Hamilton, I think I showed you this on Discord. It's my last image, I believe. Whenever you get these pops, these pullbacks, you very often see a spike in VIX, just because the VIX and S&P are majority inverse a lot of the time, in the vast majority of cases.
Not always, yeah.
Not always, but in the vast majority of cases. And whenever we see the S&P 500 in an uptrend and the VIX spikes up to 20 intraday, that's actually a positive setup going for the next week, 2 weeks, 3 weeks, 4 weeks. And this is data I got from 2016. Sorry if it's a little blurry. It's an image of an image. But so whenever you think about adding shorts is when you actually want to be buying in an uptrend. Again, that's in an uptrend. So I completely agree with Hamilton. I don't think it's worth it to try to ebb and flow through these pullbacks and try to get cute with it. Just ride the trend. If there's something that's bigger going on underneath the market, then yeah, absolutely do some position sizing adjustments. Maybe take some profits on some trades, maybe put on some shorts on your book. But for these pullbacks, I wouldn't worry about it at all.
Not at all. Okay, last question here. If the signal is so clear, why are institutions, hedge funds still so bearish and betting against the move up? I'm assuming you're referring to crypto. Now, this isn't necessarily a question that we can answer because I don't know the answer, but I think we can hypothesize. Why do you think hedge funds and institutions are short crypto if the signal is so clear that trends are higher? What do you think, Randy?
Oh man, this is a hard one. You know, I'm going to be honest, I have no clue. A lot of hedge funds have their own specific mandates. A lot of them have to
Let me
have
stop you there
some
really quick. Do you need to know?
No.
I think that's the answer. Do you need to know why hedge funds or institutions are doing anything, or do you just need to know that they're doing something, like what they're doing? This is the classic question of why versus what. If you're focused on the why all of the time, you're going to miss the what. Meaning you're going to miss the move. By the time the guys on TV tell you why Apple's up 20%, the trade's over. You don't need to wait. The simple fact is, generally speaking, when levered funds are net short an asset turning into all-time highs, over the next 3 to 6 months, asset prices are higher. You get a squeeze. We know that. That's data we can look back at and reference. It doesn't matter if it's crypto. It doesn't matter if it's the S&P 500, the Qs, the Russell. Speaking of which, the Russell as well is heavily shorted up into all-time highs. We don't need to know exactly why they're doing it. What we need to do, though, is capitalize on the fact that these trends are higher and those shorts represent fuel for squeezes higher. I think that's the bigger thing here. So if you want to go and you want to ask the hedge funds why they're net short, feel free. I'm sure they're going to give you a million different reasons. Probably they won't, though, because they lie about everything. I mean, that's the whole point of owning a hedge fund. You want to try to hide everything you're doing because the hedge funds are at war with each other. You don't want to let people know what you're doing. But we can see that data through the COT positioning stuff that comes out every single week, right? And we know that levered funds are short this stuff. So if we do get any sort of positive pop, those massive shorts are going to have to be unwound, and that's just fuel for a squeeze higher. Okay? All right. Good questions. Well, Randy, thank you so much. I appreciate you hanging out. For those of you that are new to TTI, go ahead and drop a comment, subscribe if you're new. I appreciate you guys giving us the opportunity to yap at you. And really quick, I just want to point out that even though this week was difficult, the markets pulled back, super choppy and volatile, we lost a trade on Ethereum, we still had a bunch of winning trades this week. We sold doubles, we took profits in things like gold and silver. There's always something that is moving well, folks. So it's very important. Last thing I'm going to leave you with is don't miss the forest for the trees. Meaning if you're focused on a single stock or a single asset and it's not doing well, don't let it ruin the entire image of the market, which is what we really emphasize inside of TTI. Weight of the data, look at everything that you possibly can, come up with a thesis, and then trade that thesis. As of right now, which hopefully we've proved over the last 45 minutes, we think the market's going to continue higher through the end of the year, and we think that this right now is nothing more than short-term volatility that should be bought eventually. Randy, thank you so much. We'll see you again next Friday for the next TTI Weekly Roundup.
Sounds good. That sounds good. See you guys.
See you guys.